picture this. You wake up, you pour your coffee, fire up your trading station, and look at your portfolio.
Oh, here we go.
Yeah, it is just a sea of red. Your stops are getting hit, charts are breaking down through major support levels, and instantly your chest tightens. You feel like the market has specifically targeted your account, like it's a personal attack.
A deliberate attempt by institutional algos or market makers to ruin your morning.
And exactly, to hunt your liquidity and steal your hard-earned capital. If you have ever stared at a level 2 screen and felt like the market is an adversary you're actively at war with, welcome. You are in exactly the right place for today's deep dive.
It's an incredibly pervasive feeling, even among seasoned veterans. But ironically, that exact defensive adversarial posture is usually the very thing that destroys long-term profitability.
Right.
We build these complex mental models to outsmart the tape, and when the tape disagrees, we take it personally.
And that is precisely the psychological dynamic we're going to dismantle today. Our source material for this deep dive is a genuinely thought-provoking post from the Trading Job.Blogspot.com.
A great read.
It really is. The title alone asks a question that stops you in your tracks. It's called, Are You Just Trading or Do You Love Trading? The Psychology of Market Harmony.
Yeah.
And our mission today is to unpack a massive behavioral shift outlined in this post. We are talking about moving from treating the stock market like a literal battlefield
To treating it like a collaborative relationship.
Yes.
What's fascinating here is how the blog points out that most active market participants are stuck in a rigid mindset of simply doing trading.
Doing the mechanics.
Exactly. And doing trading almost always involves fighting the prevailing trend, trying to pick exact tops and bottoms and desperately trying to beat the market into submission.
So we're going to explore why this immense internal friction exists in the first place, and more importantly, how fundamentally changing this paradigm can neutralize the anxiety that leads to emotional decision-making.
That's the key.
Let's dive right into this battlefield mentality because it really is the default setting. You fund a brokerage account and suddenly you feel like a gladiator.
Right. Shield up, sword drawn.
Yeah. The post from the tradingjob.blogspot.com notes that most people approach price action ready for a fight. They view their interactions with the market through a highly combative lens. If a position goes against them, they don't see it as a statistical probability playing out. They see it as an insult to their intelligence.
That combative lens is deeply rooted in our own behavioral biases, specifically loss aversion and the ego's need for validation.
For sure.
I mean, think about it. When you spend 10 hours researching a fundamental thesis, building a discounted cash flow model, analyzing sector rotation.
You become completely married to your conclusion.
Exactly. So when the market moves the other way, your brain registers it as a threat. The post makes a brilliant distinction to counter this, though. It draws a hard line between just doing the mechanical act of trading and truly loving the market. And it defines love in a way that is highly specific to risk management.
Okay, let's unpack this. Because this definition of love is really the linchpin of the whole argument here.
It is.
I think a lot of experienced traders hear the phrase love the market and they immediately roll their eyes.
Absolutely.
They're expecting some, new age crystal healing approach to finance. So how exactly does the source define this?
Well, it's completely devoid of romance or sentimentality.
Be good.
The blog defines love functionally as mutual agreement, understanding, and moving forward together. Think about a successful human relationship or even a successful business partnership.
Sure.
True harmony is never about forcing the other party to conform exactly to your rigid expectations. You cannot force a partner to act a certain way.
You can try, but it won't end well.
Right. And you absolutely cannot force global liquidity to behave the way your spreadsheet says it should.
That's so true.
When you love trading in this context, you are agreeing with the market's current state, whatever it happens to be, and moving in tandem with it.
Wow, that reframing completely changes the power dynamic. If you're fighting the market, you are essentially trying to bend trillions of dollars of daily volume to your personal will.
Which is
Objectively absurd when you say it out loud.
It really is.
But if you are loving the market, under this definition of mutual agreement, you are accepting price action for what it is on any given day.
Yes.
The post argues that when you finally internalize this massive psychological difference, the chronic frustration just evaporates. A stopped-out trade stops being a wound to your pride and just becomes a data point.
And that transition from a stressful grind into a state of flow hinges on identifying the exact source of your psychological pain.
Yeah.
This is where the behavioral finance aspect really shines in the piece. We tend to blame the macroeconomic environment or sudden news catalysts for our stress.
Always looking for an external excuse.
Right. But the core premise here is different.
It is a massive aha moment. The blog states plainly that pain in trading almost always comes from resistance.
Resistance.
It doesn't come from the red candles on your screen. It comes from your internal resistance to those candles.
If we look at the mechanism at play, that resistance is purely driven by the ego.
Yeah.
You're sitting there watching a position bleed out. Maybe the relative strength index is showing massive bearish divergence, moving averages are crossing over to the downside.
And your brain is stubbornly insisting, no, the market is overreacting. The market is wrong.
Exactly. The ego demands to be right more than it wants to protect capital.
Let me play devil's advocate for a second, though.
Go for it.
Because as an investor, part of the job is finding inefficiencies, right? Finding where the market is wrong about a valuation. So isn't there a danger in just blindly agreeing with the tape?
That is a critical distinction to make. Finding a valuation inefficiency is analysis. How you manage the execution of that trade is psychology. You can believe a stock is fundamentally undervalued. But if the broader market is aggressively selling it off, fighting that immediate trend with oversized positions is where the pain comes in.
Got it.
The blog gives us an absolute rule to counter the screaming ego. The market is never wrong.
Never.
Never. The market is simply the aggregated reality of all buyers and sellers at that exact second.
Which is such a tough pill to swallow. I remember looking at my screens during a massive tech sell-off a while back, absolutely convinced the market was behaving irrationally.
We've all been there.
The PE ratios look like generational steals, so I kept buying the dip, catching falling knife after falling knife, purely out of stubbornness.
Ouch.
Yeah. According to the philosophy in this post, the financial pain I experienced wasn't because the market was acting crazy. It was because I was completely out of sync with my partner.
You were resisting.
I was demanding the market recognize my brilliance instead of respecting its current momentum.
Exactly. This raises an important question, though. If we know the ego causes resistance, and resistance causes blown accounts, how do we actually drop the ego?
Right.
What does this philosophy of market harmony look like when you're staring at a live 1-minute chart with real money on the line?
The source gives us a very clear, actionable answer to that. It all comes down to listening.
Listening.
Really listening to the price action.
Yeah.
The blog uses a vivid scenario to illustrate this. Imagine a stock is breaking out. It's actively making higher highs, breaking through established resistance levels, and the volume bars are massive.
It's practically screaming, I am going up.
Exactly.
Yeah.
Now, what is the harmonious response to that scenario?
The harmonious response is to agree with the stock. If the volume and price action are confirming a move higher, you look for low-risk entries to go long.
Yeah.
You accept what the market is doing, you agree with its direction, and you participate in the trend. That is what it looks like to be in a collaborative relationship with the tape.
Here's where it gets really interesting, though, because that sounds like trading 101, right? Just follow the trend.
Right.
But the post brilliantly contrasts this harmonious approach with the trader who is just doing trading, the trader whose ego is entirely running the show.
Right. The ego-driven trader looks at that exact same breakout, the one making higher highs on massive institutional volume, and they see it as a challenge.
Yes.
They look at the chart, maybe they see an overbought RSI reading, and their ego says, this valuation is entirely disconnected from reality. It has gone up too much, too fast. I am going to short the absolute top and be the hero.
Classic.
So instead of agreeing with the market, they actively step in front of the momentum.
They're looking at the undeniable reality in front of them and saying, I am smarter than this reality.
Precisely.
The blog uses such a visceral analogy for this stubbornness. They compare this behavior to literally standing on the tracks in front of a speeding freight train.
Putting your hand out.
Yeah, putting your hand out and demanding that it stop simply because you think it's going too fast.
It is a perfect visual for a short squeeze, isn't it?
It really is.
And if we map this back to the relationship metaphor, the post says, this is the equivalent of yelling at someone you love simply because they aren't executing your personal script for their life. You're demanding they change to suit your comfort level.
If you did that in a real human relationship, standing there dictating exactly how your partner should feel and act and throwing a tantrum when they don't comply, Everyone would immediately call that toxic.
Oh, highly toxic.
You'd never expect that relationship to survive.
Hmm.
Yet, as traders, we do this to the market every single day and wonder why we feel exhausted.
And the blog explicitly outlines the consequences of that toxicity. When you yell at a partner or when you stand in front of that moving train in the market, it creates intense friction.
Yeah.
That friction quickly breeds resentment. You start resenting the market, feeling like it's rigged or entirely irrational. Ultimately, this leads to a complete breakdown of the relationship.
In trading terms, a breakdown of the relationship equals a blown-up account.
A margin call.
Exactly. Your capital gets completely wiped out because you refuse to move out of the way of the train. You refuse to agree with the reality of what your partner was communicating through price and volume.
Which naturally transitions into the next major concept in the text.
Okay.
If the goal is to preserve our capital and sustain this relationship over decades, we have to become masters of adjustment.
Adjustment, right.
We have to learn how to navigate the different moods of the market, just as we navigate the complex emotional phases of the people we deeply care about.
I love this framing because it grounds highly technical market cycles in something universally understood. We don't treat our loved ones exactly the same way every single day.
Right, you read the room.
You read the room. If they're stressed, we act differently than if they are celebrating. The Trading Job.Blogspot.com applies this exact emotional intelligence to the stock market.
It's so clever.
It breaks down 3 distinct market moods and details how a harmonious trader responds to each.
Let's look at the first mood, the raging bull phase. The post compares this to a loved one who is full of energy, highly optimistic, and wants to go out and conquer the world.
Yeah.
How do you respond to a partner in that state?
You match their enthusiasm? You don't sit there in the corner telling them why their optimism is statistically unfounded.
Right, you grew in the mood.
Exactly. In the market, when we have a raging bull phase, when broad indices are trending above their 50-day moving averages and breadth is strong, we must adjust and ride that momentum.
Yeah.
We don't overthink the why, we just use trailing stops, let our winners run, and move forward together.
Exactly. But markets, like people, do not exist in a perpetual state of euphoria.
Definitely not.
The blog then introduces the second mood, the bad day. In market terminology, this is a complex correction, a choppy consolidation phase, or a sudden spike in volatility.
Right.
The analogy here is incredibly practical. If a loved one is having a genuinely terrible day, feeling volatile and unpredictable, what is the absolute worst thing you can do?
The worst thing you can do is aggressively provoke them.
Yes.
You don't demand they sit down and have a high-stakes argument with you right that second. You don't poke the bear.
Precisely. You give them space. And the blog instructs us to do the exact same thing with the market during a complex correction.
Right.
When the VIX is spiking, when price action is whipsawing past your support and resistance zones, you don't aggressively force trades. You don't scale up your position sizing trying to win back losses.
But let me push back on that, because stepping back feels highly counterintuitive to a lot of active traders.
It does.
If you're sitting on your hands while the market is moving, it feels like you're being negligent or missing out on opportunities. How does the source reconcile giving space with the job of actually trading?
By redefining what an active position is.
Oh, interesting.
In a highly volatile, unpredictable market, going to cash is an active position.
Okay, yeah.
It is the ultimate expression of giving the market space. You step back, you let the market work through its structural volatility, and most importantly, you protect your mental capital and your financial capital.
You survive the bad day so you can trade the next good one.
Exact.
That makes total sense.
Yeah.
It is defensive driving.
Yeah.
Then we have the third scenario, outlined in the post. The downward trend.
Bear market territory.
Right. The market is clearly heading lower. The blog emphasizes that in this situation, you do not buy out of pure stubbornness.
The sunk cost fallacy.
Yes. This is where it traps so many people. They watch a stock drop 20%, buy more to average down, watch it drop another 20%, and keep buying just to prove their original thesis wasn't wrong.
And that behavior completely ignores the reality of the partner. The harmonious trader accepts the downward trend.
Yeah.
They might look for short setups or they might just stay out of the way, but they absolutely do not dig their heels in and insist the market is wrong. This is where the core philosophy of the source text reaches its peak. Why do we accommodate these moods? Why do we step back when it's choppy or accept a downtrend instead of fighting it? The blog's answer is profound.
Go ahead.
You accommodate these moods because you value the relationship itself more than your ego's desperate need to be right.
Valuing the relationship over the need to be right, that is a massive psychological pivot.
It changes everything.
Because let's be honest, your ego desperately wants to buy the exact bottom of a falling stock, have it instantly reverse, and post the screenshot to show everyone what a genius you are.
Of course it does.
But the harmonious trader says, I care more about staying in sync with the market's reality than I care about proving a point or feeding my ego.
And this brings us to the ultimate state of evolution outlined in the text, becoming what the blog calls a frictionless trader.
A frictionless trader. Even just saying it lowers my blood pressure.
Right.
The post argues that when you finally stop trying to conquer the market and you commit to harmonizing with it, your entire experience of trading fundamentally shifts.
It really does.
The anxiety we talked about at the very beginning of this deep dive, that tight chest on a red day, it dissipates entirely.
It dissipates because you have surrendered the illusion of control.
Yeah.
The blog makes a crucial observation here. You stop feeling anxious because you are no longer trying to predict or force the future. Anxiety in trading almost always stems from the gap between what you want to happen and what is actually happening.
That gap is exhausting.
It is. When you close that gap by simply accepting what is happening, the stress vanishes.
Yes. You aren't playing a high-stakes guessing game anymore. You aren't treating every tick on the chart as a verdict on your self-worth.
Exactly.
As the source beautifully illustrates, you are simply holding the market's hand and walking in whatever direction it decides to go.
Yeah.
If the volume and trend decide to walk up the mountain, you walk up the mountain.
Right.
If the structural trend breaks and walks down into the valley, you walk down into the valley.
Yeah.
You are a follower of price, not a dictator of it.
If we connect this to the bigger picture, it completely rewires our definition of success in this industry. The blog's central plea is, don't just trade. Love the process of trading.
Yeah.
Listen to the tape, respect the moving averages, drop the ego, and actually observe the journey. When you achieve this state of frictionless harmony, something incredibly interesting happens to the financial side of the equation.
Right. So what does this all mean for the actual P&L? Because we can talk about harmony in relationships all day, but at the end of the day, people are looking at these charts to generate a return.
Of course.
Does adopting this Zen-like approach mean we stop caring about making money?
Not at all. In fact, it's the exact opposite. The blog makes a brilliant concluding point. When you are truly in harmony with the market, the profits become a natural byproduct of the relationship.
A natural byproduct.
Yeah.
It's like in any genuinely healthy human relationship, happiness, trust, and growth are the natural byproducts of mutual respect and active listening. You don't wake up every day and try to force happiness out of your partner. It happens organically because the environment you've built is healthy.
Precisely. The frictionless trader isn't sweating and fighting for every single dollar, trying to squeeze water from a stone. They're just keeping in step with their partner.
Yeah.
They take the setups the market clearly offers, they step aside when the market is confused, and the dollars accumulate as a mathematical result of that alignment.
It stops being this elusive, stressful target
Yeah.
that you have to aggressively hunt down.
Exactly.
It fundamentally neutralizes the emotional volatility that destroys so many accounts. Instead of viewing a red candle or a broken support line as a threat, you just view it as communication.
It's just feedback.
Right. Your partner is telling you, hey, I'm changing direction right now.
Yeah.
And your only job is to say, okay, I hear you. I'll adjust.
It takes the target off your back because you finally realize the market was never shooting at you. It was just doing its own thing, and you were stubbornly standing on the tracks.
It is an incredibly liberating perspective from the Trading Job.Blogspot.com. It takes trading from a battle of attrition and turns it into an exercise in deep observation and self-mastery.
It really does.
Well, as we wrap up today's deep dive into the psychology of market harmony, I want to leave you with a final thought to mull over.
Okay.
If dropping our ego and treating the incredibly complex, data-heavy stock market like a collaborative relationship rather than a battlefield leads to better financial outcomes and significantly less anxiety, what other highly stressful, data-driven areas of our daily lives could completely transform if we replaced our need to conquer them with a desire to simply harmonize with them? Think about it. We will see you next time.